Smart investors respect time as a financial force. Time multiplies both growth and decay. Capital must be positioned to benefit from time. Assets allow money to participate in economic growth. Businesses expand productivity. Most people believe having more cash automatically means more security. They see a large number in their bank account and feel protected. The balance feels like a shield against uncertainty. That feeling of safety is powerful. It creates comfort and emotional stability. It makes people believe they are financially responsible. But smart investors see cash differently. They see cash as a temporary tool. They understand cash is not a long-term strategy. Cash has a specific role in a financial system. Cash provides flexibility when life becomes unpredictable. Cash helps you stay calm when others panic. But too much cash creates a hidden problem. Money sitting still slowly loses potential. Unused capital quietly weakens future growth. Smart investors do not aim for maximum cash. They aim for optimal cash. They hold enough to stay stable and flexible. Everything above that level needs direction. Every dollar should have a clear purpose. Money without direction loses efficiency. The biggest mistake most people make is emotional saving. They save based on fear instead of structure. They keep increasing cash without defining a limit. Fear tells people more cash equals more safety. Structure tells investors how much cash is actually necessary. Clarity removes the need for guesswork. Smart investors calculate their real cash needs. They measure stability using expenses instead of emotions. They build cash reserves with intention. The first layer of cash covers daily life. Monthly expenses define the operating level. This is the foundation of financial stability. The second layer is the emergency reserve. Unexpected events require immediate liquidity. Prepared investors remove panic from financial decisions. Emergencies are specific situations. Job loss requires temporary support. Medical expenses require immediate access. Market downturns require emotional control. Cash prevents forced selling during volatility. Liquidity protects long-term investments. Once this protection exists, excess cash becomes inefficient. Idle money stops contributing to financial progress. Unused capital slows momentum. Smart investors understand opportunity cost. Money kept inactive cannot grow simultaneously. Every inactive dollar delays future flexibility. Cash feels stable because the number does not change, but purchasing power changes continuously. Inflation quietly reduces what money can buy. Inflation works slowly but consistently. Prices increase while cash stays visually the same. Time amplifies this invisible effect. Tie over time. Markets reward long-term participation. Investors understand uncertainty exists in all strategies. Holding cash carries long-term uncertainty. Investing introduces short-term variability. Smart investors accept controlled fluctuation. They prioritize long-term trajectory. They measure progress across decades. Cash supports strategy when used intentionally. Cash creates optionality in uncertain environments. Cash allows patience during market volatility. Optionality creates advantage. Prepared investors act when opportunities appear. Liquidity allows intelligent decision-making. Opportunity rarely appears on schedule. Market declines create entry points. Economic cycles create asymmetry. Investors with available capital respond faster. They allocate resources strategically. Preparedness increases decision quality. Smart investors structure cash with boundaries. Limits prevent emotional accumulation. Structure prevents unnecessary hesitation. A defined allocation creates clarity. Clarity improves financial consistency. Consistency compounds over time. Financial progress rarely depends on income alone. Progress depends on how income is directed. Direction determines financial efficiency. Efficient allocation multiplies long-term outcomes. Inefficient allocation reduces momentum. Structure transforms ordinary income into growth potential. Smart investors focus on system design. Systems remove the need for constant decisions. Automation protects consistency. Automatic investing reduces emotional interference. Consistency improves probability of success. Time rewards disciplined processes. Cash remains part of the system. Cash supports flexibility during transitions. Cash stabilizes decision-making environments. Balance creates resilience. Resilience allows long-term thinking. Long-term thinking supports wealth creation. Wealth is rarely created through extreme decisions. Wealth grows through structured repetition. Simple systems outperform emotional reactions. Smart investors avoid extremes. They avoid excessive risk concentration. They avoid excessive liquidity accumulation. Balance supports sustainability. Sustainable strategies survive uncertainty. Survival allows compounding to operate. Compounding requires patience. Patience requires confidence. Confidence requires structure. Structure begins with clarity about cash. Cash is a tool, not an objective. Tools should be used efficiently. Every dollar represents stored effort. Stored effort should produce future optionality. Unused effort reduces financial leverage. Smart investors respect the value of momentum. Momentum increases financial flexibility. Flexibility increases life options. Financial independence is built gradually. Gradual progress reduces emotional volatility. Stability supports disciplined behavior. Behavior determines financial outcomes. Financial outcomes reinforce behavior. Positive cycles create long-term advantage. Cash is valuable when it protects strategy. Cash is inefficient when it replaces strategy. Clarity defines the difference. Smart investors measure cash relative to needs. They avoid measuring safety through absolute numbers. Context determines appropriate allocation. Financial clarity reduces anxiety. Reduced anxiety improves decision quality. Improved decisions strengthen financial trajectory. Money performs best when guided intentionally. Unstructured money creates uncertainty. Directed money creates progress. Smart investors build systems before chasing returns. Systems provide stability during volatility. Stability supports rational allocation. The goal is not zero cash. The goal is purposeful cash. Purpose increases financial efficiency. Smart investors think in roles. Each dollar serves a defined function. Defined functions reduce confusion. Cash protects stability. Assets build growth. Systems connect both elements. Financial maturity requires balance. Balance supports long-term adaptability. Adaptability supports resilience. Resilient investors navigate uncertainty calmly. Calm decision-makers avoid destructive mistakes. Avoiding mistakes improves long-term results. Wealth is preserved through discipline. Discipline transforms ordinary resources into extraordinary outcomes. Consistency builds durable advantage. Smart investors understand this early. They structure liquidity intentionally. They deploy capital strategically. Because money that moves with purpose grows stronger. Money that remains idle grows weaker. Direction determines financial evolution. Financial clarity creates confidence. Confidence encourages long-term thinking. Long-term thinking builds independence. The goal is not more complexity. The goal is more intentionality. Intentionality creates measurable progress. Smart investors do not chase every trend. They refine simple, repeatable systems. Repeatability builds reliability. Reliability builds trust in the process. Trust allows patience during uncertainty. Patience allows compounding to operate fully. Wealth rarely appears suddenly. Wealth accumulates gradually through structure. Structure transforms behavior into results. Smart investors keep less cash than most people expect because they understand the role of liquidity, because they understand the power of allocation. Cash protects the system. Allocation grows the system. Balance sustains the system. Financial independence begins with clarity. Clarity begins with structure. Structure begins with intentional allocation. And once allocation becomes habit, money starts working more consistently. Consistency creates freedom over time.